Good evening, everybody. I'm Koku Pascal Adalessossi. I'm a PhD student. Next year I will finish my PhD program. I am specialized in finance. I want to talk a little bit about the finance, mostly concern bonds. We know that a function of a financial system is to intermediate between a lender and a borrower, so that a transaction and information cost can be reduced for both of them, or for the both parties. Yes, when we know that financial system is composed of 5 core, in which each for one play a vital role in the economy. These cores are money, and we know the role that the money play in the economy. One of the role is a stock of value and a reserve of value. It's very important, so that is one of the instruments. And for the second, we can talk about financial instruments. And we know all of financial instruments that we use, like bonds, like share, are very important. So, and also we can talk about financial markets. Market, they play a big role in the economy. They channel the resource from the low sector, or from the low growth sector, to the potential or to the fast growing sector. And by financial market, they share the information, and they also, by the role that they play, it means that transaction costs are reduced. Also, you talk about financial institution. Financial institution, we know them also as financial intermediaries. They play a big role in the economy. So they play the role of brokerage and the role of asset transformation. Asset transformation, you can say that they transform illiquid asset to liquid assets. So when you want to talk to for the last one is a central bank. Central bank is a regulator. It's there to monitor the economy, to stabilize the economy, to stabilize the inflation, the inflation rate, and also to improve the employment rates. That is very important. And as we know, for the financial institution, we know bank as the most intermediary financial institution, and we know the role that the bank play. As I am talking now, for example, in West African West African economy and the monetary union, the financial system is a bank-based system. Also, I want to talk about the capital adequacy ratio. Capital adequacy ratio for banking organization is a very vital and a crucial issue that receive a full attention in finance literature. It can be defined as a measure of bank risk exposure. Bank risk can be classified in 4 groups. We can say credit risk, when bank is going to lend the money. If he cannot recover this money, it means that there will be a credit risk. We can talk about market risk. When we talk about in portfolio theory, an investor can never diversify, can never avoid the market risk. He can avoid unsystematic risk by diversifying this portfolio, but cannot diversify it. He cannot erase market risk. Cannot avoid it. That's what I mean. We can talk also interest rates, interest risk, and also exchange rates. Exchange rate, we know, in balance sheet, in off balance sheet of bank, exchange rate it depends if this bank is operating in floating system. It means that he assets when the money, the inflation come, or when the deflation come, so he can have problem about exchange. That's what I can say about it. And I want to talk about also profitability. Profitability play a key role in a bank or in every company, every company. If a bank or a company is profitable or have a profit, this will enhance his capital. As we know in capital structure theory, we know that for the peg order theory, bank prefer internal financing. Internal financing came from profitability. When the bank is profitable, so you can say in return, any return, you use return N to finance the project. When internal financing is not available, you can use debts, and after you can issue a share in capital markets or in stock market. That is very important. But decline in the bank profitability have also been linked to financial instability. According to Borio, the scholar Borio, researcher Borio, yes, we have to do something in this line. In economic environment where the ability to bounce back the economy shock is highly important. So profitability is a very, very critical attribute for the development of the company. That's what I can say. So we know that a lot of things in finance play a big role in the economy. I want to present West African economy and monetary union. It was created in January 1994, and it is composed of 7 countries, French country. 3 years later, there is another country, Portuguese colonized country, is Guinea-Bissau. We have joined them 3 years after. So in this monetary system, they use a custom union. A custom union, they use the same currency, is safer. It is safer, and they have greater economic competitiveness, and they have convergence of macroeconomic policy and the indicator. So according to some news or some research, the area, the WAEM or West African Economic Monetary Zone, is counts 112 million of inhabitants in 2015, and it covers an area of more than 3.5 million square of kilometers. It's very, very important. And why the thing going out? I want to present macroeconomic indicator in West African economic monetary between 2006 and 2014. Between them, we know where economy between 2000 and 2014 has low, have down, and up trends. So particularly for the international, the financial crisis in 2008, they have touched a lot of developed countries, but surprisingly, it did not touch West African economy, monetary economy. Why not? Why? And we know when we want to talk, we have a good situation of economic growth. In 2015, the economic growth is about 6.5%. And we have low inflation rates in the zone, in the union. When we talk about the public finance is mostly based on treasury bill and government bonds. When we want to talk about the balance of payments, we know between 2010 and 2014, the current account was deficit. It's deficit. Why it is deficit? Because the government has empowered the saving rates and the investment rate by the construction of infrastructure. And for example, building the road, construction, a hospital, and so on. That is very, very important thing I want to show. That is a little bit thing that I want to show today. But what the central bank used to do, the action of a central bank in monetary zone, in monetary action. The central bank use some indirect instrument like interest rate policy, who has objective to stabilize financial sector by regulating the bank liquidity. The bank liquidity. It also come in the form of open market operation, which is something who happen between interbank. So the central bank come to inject liquidity in the sector. It came also by refinancing window and also by the reserve requirements system, so that each bank in West African economic monetary have reserve account in the central bank. And the central bank come to monitor those things, use those reserves to monitor a lot of things in the area. So when we want to talk about the trend of monetary aggregates, we can talk about net foreign asset who has a acceptable trend between that period. Also domestic credit. Domestic credit is composed of net government and credit to economy. Credit to economy, we have a credit to a short-term credit, a long-term credit, and average medium-term credit. And then we know between this period they have a good trend. That is. So I want to talk also about macro convention program, but I will do it in my second video program. Thank you very much. See you.